The UK market has performed well, helped by a fragile but strengthening recovery in the UK economy and a stabilisation in the Eurozone, although performance in emerging markets has been a little bit weaker than expected. I think it's interesting that the market has moved higher as a function of higher earnings multiples rather than higher earnings, and I think we will need to see an improvement in the latter if we're to make further progress. It hasn't been the easiest of trading environments, but companies are generally performing well, although we have seen a little bit of weakness from some of those companies exposed more to emerging markets. I think in general, over the last couple of years, companies have benefited from the weakness of labour to restructure. They've benefited from technology and used innovation to help drive sales growth. Murray Income's objective is to achieve a high and growing income combined with capital growth through investment in a portfolio principally of UK equities, and that's something we try and do in a conservative manner. We can also invest up to 20% of gross assets overseas, and that helps us to diversify risk and gain access to companies and investments that can't be found in the UK. The benchmark is the FTSE All-Share Index, and we would normally expect the portfolio yield to be at a healthy premium to the index yield. The Trust has performed well on an absolute and relative basis, with the share price and NAV outperforming the index over 1, 3 and 5 years, and over that time period we've continued to grow the dividend. Turnover tends to be low given our patient buy and hold approach, but one new introduction to the Trust has been Inmarsat, a satellite communications company that offers global coverage, has high barriers to entry and good growth prospects from the launch of its Global Express service in early 2015 that delivers significantly higher capacity. The UK is home to some great companies that offer growth not just in the UK but also overseas and have some very strong competitive advantages. That might be intellectual property, so strong brands and patents. Many have deep experience of operating abroad, particularly in faster growing emerging markets, and they benefit from skilled human capital. And I think it's also worth bearing in mind that they operate within a very strong legal and corporate governance framework. Given the scarcity of income from other investments and asset classes, I think now is a particularly attractive time for UK equity income investing. But I think a bias towards UK equity income investing is always sensible, given that numerous studies have demonstrated that dividends and their reinvestment generate a very significant proportion of total returns over the long term. Dividends act as a touchstone for the strength and health of a company, and I think the ability to pay dividends encourages a disciplined and long-term approach to the stewardship of a company. The market currently expects high single-digit dividend growth for 2014, which I think may be a little bit optimistic, but there are a couple of reasons to be relatively reassured. The first one is that payout ratios are relatively modest, and secondly, company balance sheets are strong, which gives them optionality in terms of increasing their dividends or perhaps buying back shares or engaging in M&A activity.